CEO and Head Equity Strategy at Tower Capital and Securities Private Limited, joins us from Bombay. Sandeep, morning, welcome to NDTV Profit. First and foremost, your comments on whether an improvement in monsoon could actually lead the markets higher, or again are concerns still on as to if a below normal monsoon could actually impact the markets from an earnings perspective, also from a sentiment perspective.
Good morning, Ashu. Good morning, Namrata. Ashu, to answer your question, what we have at the ground level, the situation of monsoon is whatever damage has been done that cannot be recovered. So we need to focus on what is left, whether the situation can be salvaged if monsoons recover. Now, what we have found out from the ground level research, based on the farming statistics of UP, Punjab and the whole of north and central India, that the paddy cultivation, about 50% of the produce is already, we've missed about 50% of the production. Now the question is, what happens to the remaining 50%? Now if monsoon doesn't improve for the next 3 weeks, we could be looking at about 70% of the produce completely going away. So that's a very big concern, very major concern. I'm not going to comment on a day-to-day movement of the market, but looking a quarter or two down the line, we can have a situation which may turn out to be quite grim.
So is it safe to assume that agri-commodity producers and sugar stocks particularly could actually take the biggest knock? Mind you, there's already been concerns that the sugar cultivation for this particular year could be below what we actually saw last year. 25 to 23 million tons was what happened last year. This year it could be as low as 14 million tons. That's a previous estimate, and you add on the monsoon impact, it could be substantially lower.
You're right, and to add to that, the prices of the sugar cane that the farmers are fetching right now is about 150 to 160 rupees a quintal compared to the minimum state price of administered price of about 112 to 115. So what you're saying is absolutely right. There'll be availability of sugar cane will be, and it is already becoming a major problem. But having said that, the sugar companies which are port-based will stand to benefit because they can import raw sugar and refine that sugar. So they save on the freight cost, which is about $30 to $35. So definitely companies like Renuka will benefit, and companies which are geographically located in the hinterland of India, the central and north India, will have a negative impact.
Sandeep, morning, Namrata also joining in. In terms of, the moves from the government side for some of these companies, yes, output will be hit, so production will be lower, so volumes will fall. But more importantly, policy bans have already started. You've got wheat exports which are banned, yet again sugar, there's likely to be some kind of control. All these agri-sensitive commodities will see increased government intervention going forward. So doesn't that make for a case of almost a double whammy, because you're not getting the volume growth and then the government is coming and curbing some of those exports or your business growth?
Yes, in economic sense, as far as the companies are concerned, yes, it is a double whammy. But you need to bear in mind, Namrata, that the food article prices. Now we check the prices in the wholesale grain market in Navi Mumbai, which is one of the largest markets in India. And over the last week, what we have found out that the pulses, wheat, rice, they have gone up by 20 to 36% in just a matter of 5 to 6 days. So we need these kind of measures in order to control the prices. But on the supply side of it, as the agriculture is not up to the mark, what remains to be seen is to what extent will the government release the buffer stocks, and there will be a lag, because we can see prices going much higher from these levels. So you have a section of population, which is about 70% of our population, totally agri-dependent, and then they normally don't buy food, they just produce and eat what they produce. So you're looking at their spending, the consumer spending on these of this segment of the population completely dying out, because they'll be focusing more on how to make ends meet. Then you have the remaining 20-25% of the population, the lower and middle income group. Now the food articles will now comprise will take over a major chunk of the household budgets. So again, you have the consumer discretionary spending coming under severe pressure. So the traditional sectors like FMCG, which have been the defensive ones so far, they will not remain defensive. We need to redefine defensive in these market scenarios. So even the two-wheelers, four-wheelers, anything that is dependent on our majority of the population, because we need to bear in mind that the multiplier effect is enormous in terms of their spending power on the whole economy.
Sandeep, that's an interesting point, because I have a fundamental disconnect between what the monsoon seems to be suggesting, and in historical basis, every time we've had a poor monsoon, FMCG stocks and autos and so forth linked to the agricultural space have been net underperformance on a 12-month basis versus the index. But the budget, the only thing where a clear positive was seen was the FMCG space. The surcharge has been removed, so you got personal income tax, so more discretionary spend, which has come up in focus, and the rural spend has been really pretty much the highlight of the entire budget. So in that sense, when you're saying that FMCG stocks could well not be defensives, where would you go?
That's a very difficult question, right now. Maybe look at the annuity-based businesses like power sector to a certain extent. And as you mentioned, that the excise duties have been reduced in the FMCG space, but the prices may come off by 1 or 2%, but look at the input prices. Input prices are going up 30, 40, 50%. So you'll have a margin squeeze for the FMCG players that is not factored in right now. And the budget, fine 3% income tax has been reduced, but the indirect taxes have been raised. So net, if you look at it in terms of what money you have, the spare money to spend around is almost the same. So I don't see much positives on what we have seen in the budget so far.
Alright, the budget seems to be history now, but earnings seem to be the next big trigger. Sandeep, if I can get your comments particularly on how the earnings season is looking. Infosys numbers behind us have been above expectations. Axis Bank numbers also gave a positive surprise, but help us understand what's the broader outlook there.
The earnings season for the next 2 quarters will be a mixed bag, and we need to bear in mind that we are heading again, the interest rate cycle is turning up. So if you've seen the past correlation, whenever the interest rate cycle starts to inch up, it's not that conducive or positive for the equities. So you'll see earnings pressure again coming in for the companies who've got higher interest cost to bear, and availability of the credit will be a concern, because government's borrowing program seems to be very, very large, which may end up sucking up most of the liquidity. So as you said about the Infosys, which is a global company, and rest of the IT pack, they may remain stagnant in terms of growth, but yeah, the cash flow and they provide a good defensive to a certain extent, not definitely in terms of growth. No.
What about real estate and some of the other infrastructure companies? You think the worst is still on for the real estate sector?
Real estate, we haven't seen at the ground level demand picking up really. It's more a function of money that they have borrowed from the market, and they're raised from the market. So their balance sheet seems to be a bit healthier so that they can survive this downturn. But if I were to put my money and saying that worst is over and I'll buy real estate stocks, I would be a bit hesitant. I'm not very keen. We need to see ground level reality, the spending power of the consumers increase, and they go in for buying first time buyers emerge, or the second investment homes buyers emerge.
Today is just one of those trading sessions wherein from a sell-off we have seen some bit of recovery coming in. But Sandeep, if you can also get your comments on the banking sector, particularly the private banking stocks. Today is a good day, but largely on the back of Axis Bank numbers being above market expectations. But what's the broader call on the private banking space, ICICI numbers and some of the other big names?
Axis has definitely shown a great improvement in its numbers, but ICICI has, you've seen over the last 6 months, they have cut back on the lending, so the numbers will be muted. But I think the worst provisioning may be over for ICICI. But from the growth perspective, we may need to wait for a few quarters. But if you were to look